What's going on, guys? How are you? How are you doing? Today I want to show you how to trade the higher time frame empty spaces. So what I want to do today is to teach you how to predict the next move in the market by looking at the impulses that you see. So we have this impulse, then we have this impulse, and we have this impulse. What I want you to do is to identify the impulse, then predict the next move, which is to mitigate this impulse, mitigate this impulse, and mitigate this impulse. The rule of thumb is that when a market or a higher time frame chart shows you this empty space, so this we are calling this empty space because it is sometimes referred to as a liquidity void. So we mean that empty space. So when I say empty space, I'm referring to these impulse areas that you see. So after every impulse, you see a move that that starts to go down. So what I want you to do is to understand how to trade the other move, not the impulse. So on this channel, I've been teaching you how to catch the impulse, but some of you are not are able to actually catch the impulse. So what I want to teach you now is how to trade the opposite of the impulse. So let's just go right into it and explain what you need to do. So number one, you have to understand when an impulse is exhausted, right? When an impulse is exhausted, you look at this high. So if you look at this high, you wait for at least 2 candles that go in the opposite direction, which means if the impulse is bullish, you are waiting for 2 bearish candles. So you are waiting for this one and this one. So after these 2 bearish candles, what are you going to do? After the 2 bearish candles, you are going to go to the M15 now. After this, right, you are going to go to the M15 and try to go down with this with this movement as you close, or as the price closes the empty space that we are talking about. Same applies here. You will have to wait for at least 2 bearish candles, right? After waiting for 2, you go to the lower time frame and use market structure to enter into a trade that you want to enter. So let's go to the M15 and try to see from here how price would have fared and how you would have gotten your entry into the market. Remember, we are going on to the M15, and let's see here. This is where we are talking about, right? After that, what are you going to do? You are going to use market structure to catch this move that goes down. But remember, you don't have to be greedy. You are going to be waiting to catch a small portion of that move. Don't try to exhaust everything. So what you're going to do is you're going to be waiting for a candlestick pattern that shows you. So after identifying that this is now a downtrend, or this is now a retracement, as it should be, right? You go and wait for a retracement and a move back. So the retracement that you would have waited for is this one. After this candlestick pattern, the engulfing one, you enter your trade right there, and your stop loss goes above this zone, and you just go for maybe an hour or so and you exit your trade. Remember, this is the M15, so you don't need to overstay your welcome. So that's what we are doing. So let's just go back and look at these empty spaces and how best we could be taking advantage of it. Let's look at this trade right here, where price went up for the whole week, right? So this is the whole week that you see price going up, right? The beginning of the week, what are you waiting for? You're waiting for 2 bearish candles to confirm the change of direction. Then you go to the M15. What are you seeing on the M15? Let's just go where price is. On the M15, you're just waiting for a retracement and a candlestick pattern that confirms the direction that you want to go. So what are you seeing here? We have a retracement. Then we have a candlestick pattern. This is an engulfing candle. As you can see, you enter there, you stake, right? You have a retracement. Then after a retracement, what do you see? An engulfing candle. You stake, right? You have another retracement and price is going down. Another retracement, and what do you see? You stake. So you are seeing a railroad track, an engulfing candle, and star patterns. Those are the patterns that you are looking for and that you are taking advantage of when it comes to this. So you can be trading like this for a week and just looking for these retracements. Let's look at another chart, right? So this is another empty space, right? Price was going down, right? It needs to go down to kind of balance off what is happening here. Remember, trading is a zero-sum game. You can't win money if there isn't someone who has lost money, right? So if you win $1, someone has lost that dollar. If you win $1 million, someone has lost that million, right? So that's just how trading is. So there should be an act of balancing of these aggressive moves that you see. Let's start here. We have an aggressive move down that takes out structure. So you wait for how many 2 candlestick patterns that go to the opposite direction. Then you go to the M15. Look at that pattern, right? And try to find a trade using using market structure. This is what I'm talking about. After this, you wait for a retracement. Where is the retracement? The first retracement is here. And what do you see? You see a tweezer. So these are called the tweezers because there are two pin bars. So after this tweezer, you get in. This is 45 minutes. You are out. Why are you out? Because there is this high here. So after closing of this candle there, you are out. Remember, this is scalping. This is a high level scalping that you are doing, right? So you go back again and look at here we're looking at the H4. We were looking at the H1, right? So this is the H1, and after this, what are we going to do? You're going to do the same thing. 2 candles, then you go back to the M15 and try to get a trade, right? So after this, what do you see? Price goes up, right? And it retraces. After retracing there, it gives you a railroad track. You enter there. After entering there, you make money. So it should be as simple as that. But you have to understand that these strategies are not 100%, right? They are not 100%, and you have to be sure what you are doing. After being sure, you have to be willing to lose some money, because these are high probability, but they are not 100%. So you might lose some money. And if you are new to these indices, right, and you like them, you like what you are seeing, the links to join this broker that offers these indices are in the description down below. Register now, find and start trading, because you can't be letting these things go. These are very easy to trade and they move 24/7. So you gotta be involved. You should be trading these ones. So I'll see you in the next video. I hope this was helpful. My name is Shocks and I'm out. I'll see you next time. Bye bye.